is a mortgage REIT. We're the largest mortgage REIT in the sector with $85 billion in assets and $13 billion of permanent capital. We have three complementary investment strategies. One is our agency mortgage backed security business. We also have a residential credit business, so non-agency resi loans and securities. And we have a mortgage servicing rights business, or an MSR business as we call it. Since our founding, our core expertise has really been in the agency MBS space. Those are loan pools backed by government-sponsored entities, Fannie Mae, Freddie Mac primarily, which are guaranteed by the U.S. government, so therefore don't bear credit risk. Our portfolio now is roughly 90% of our assets in agencies, so that's about $75 billion of total assets. The second business I mentioned is our resi credit business. So again, residential whole loans and non-agency securities conducted through our Onslow Bay correspondent channel. We started that channel in 2021 to acquire loans from a network of origination partners. We currently have over 275 origination partners where we buy loans and we securitize them to provide non-recourse financing to our balance sheet. Over the last several years, we've efficiently scaled this business. We've done over $35 billion of securitization since 2018. So we're currently the largest non-bank securitizer of residential credit. We also take pride in having the lowest delinquency rate when we think about delinquency 60 days and longer of the top 10 non-QM issuers. And finally, over the last several years, we've built out a premier mortgage servicing rights portfolio. We're now a top 10 non-bank servicer with a greater than $200 billion UPB portfolio of MSRs, and we were the third largest buyer last year of MSRs. So it's really this combination of these three businesses that are complementary to one another, and we think provide key synergies that ultimately enhance shareholder returns. It was founded in 1996, ultimately went public a year later in 1997 on the New York Stock Exchange. And the idea was to bring investing in mortgage-backed securities to retail investors. At the time, investing in MBS was really only available to large institutional investors. And doing so through our REIT structure, where we distribute over 90% of our income, allows us to provide an attractive source of income, both to retail and institutional investors. As a public company, as a public REIT, we're also able to efficiently access capital. We've been able to deliver a low double-digit yield since inception. We've delivered over $27 billion of dividends in the history of the firm. Agency MBS has always been the core of the portfolio since the firm started. Currently, we have about 60% of our capital in agency MBS, but we've built out these complementary resi credit and MSR businesses such that we now touch all aspects of the mortgage loan. So 27 years of experience in managing money as a public company. We've been through many different markets. We've been through the 2001 stock bubble, the 2008 housing crisis and Great Recession, and the global COVID-19 pandemic more recently. But through all of that, we were able to deliver a total of 950% total shareholder return since the IPO in 1997, which compares very favorably to other asset classes. A number of key trends that we think support the business both near term and long term. On the agency side, some tailwinds include the fact that agency spreads are trading at levels that are historically attractive. We're able to attract new money returns in kind of the 16 to 19% range. We do see ample opportunity for spreads to tighten in this environment. There's strong demand for the asset, and with lower fixed income volatility, should that come, we see a lot of support for book value. Agency MBS does screen attractive relative to corporate credit and other fixed income alternatives right now. That's demonstrated through strong fund flows into the sector. And also to the extent we enter a market where economic growth does slow, agency assets have done well during a recession. It's that lack of credit risk and the safe haven aspect of the asset that we think will also serve well in a down market. Moving to the resi credit side benefits from some long-term structural tailwinds in the housing market. There's an undersupply of housing in this country generally, which will take years to build out. We do see mid double-digit new money levered returns on the resi space as well. Many research sources today predict that non-agency issuance can grow 20% this year. And we think our correspondent channel is very well positioned to benefit, from that growth. Underwriting of mortgage credit has remained conservative post-Great Financial Crisis, with pretty strong credit standards in the industry. And borrowers have also accumulated record levels of equity in their homes, given the price appreciation that's occurred in recent years. And finally, on the MSR side, MSR is well positioned given strong cash flows that come out of having low note rates on the MSR right now. Our portfolio has about a 3.2% average note rate. It's well below current mortgage rates and provides protection from refinance for the portfolio. So we also on the MSR side have very strong partnerships with industry-leading subservicing and recapture partners, which differentiates the platform from other MSR holders. And I think the final thing I'll mention is with expectations of rate cuts, that is supportive of our business. We can quickly translate those rate cuts into earnings, given the majority of our borrowings are through the repurchase market. I think really one of the biggest risks to the mortgage REIT sector in general and the agency strategy is elevated volatility. Over the last few years, we've seen exceptional volatility, both to interest rates and to mortgage spreads. That volatility has challenged the sector, particularly when the Fed was raising rates. We actively hedge our portfolio and we mark to market daily. So those gyrations in the rate and spread markets can really erode book value in times of stress. Volatility has improved somewhat relative to 2022, 2023 levels, but there are risks that persist that, we saw as recently as April with the tariff-related volatility. So we've conservatively positioned our portfolio in recent years, given the expectations for this higher uncertainty. Notably, we entered the year with the lowest economic leverage for our firm in the last 10 years and ample liquidity, which did position us well for the trade war uncertainty relative to some of our peers. This was evidenced by the strength of our investment returns. We earned our dividend with this lower leverage, which we're proud of. I'd also mention on the resi credit portfolio, I did talk a little bit about the housing market, which is fundamentally sound, though you do see prices gradually softening as inventories start to normalize and affordability challenges persist. Any material elevation in consumer delinquencies or any prolonged downturn in housing could cause stress in that market too, so that's a risk. But as we mentioned previously, we see the housing market is fairly well positioned. The robust underwriting standards of the last few years, record home equity with U.S. homeowners, and this undersupply of housing, we think provides some pretty good support for the housing market overall. One key topic I also just want to mention is the potential privatization of Fannie Mae and Freddie Mac under the current Trump administration, which has been getting a lot of press. Some in the industry are concerned about the risks of the mortgage market if privatization does occur in a disorderly fashion. But consistent message we've been hearing from both the administration and lawmakers is that they will approach this in a thoughtful manner. Trump recently reiterated that the government will continue to implicitly back Agency Mortgage Backed Securities, which is a positive. And to the extent the GSE does reduce their footprint and get out of some non-core products, which could make up to 20% of the portfolio, those will likely get pushed to the private market, and we do believe we're well positioned to acquire and securitize those assets. So again, a tailwind to the growth of our business. So first and foremost, I'd mention just the advantage we have relative to our peers is our size and scale. We're the largest, we're the only one in the sector that invests across the spectrum of housing finance. Most of the smaller peers in the industry only invest in one part. We have a diversified portfolio, we're liquid, actively managed, and we've been able to, and we think we'll continue to be able to perform across a variety of economic scenarios. The portfolio has significant synergies with these three business areas, and with that is potential for superior risk-adjusted returns. Over the last 2 years, we had a 17% economic return. We outperformed all monoline agency and resi credit peers. We paid an attractive 15% dividend. We increased that in March, given the strength of the investment returns I referenced earlier. We paid a dividend every quarter since the inception of the firm over 27 years ago. It's also a highly efficient platform. We have an operating expense ratio of 1.4% of our average equity of last year. That's really a testament to the three fully scaled businesses. But I think lastly, and most importantly, are the people are what make NLY a best-in-class organization. We believe we have the most talented people in the industry. They come to work every day, very dedicated, and would do their best to make this organization the best it can possibly be.